We are back, and it's time for Ask Annex. As always, you got a question for us, you head to our website, annexwealth.com, look for the Ask tab, and if we can help you, you always click that Get Started button. In the studio, Sarah Kyle, a wealth manager at Annex Wealth Management. Welcome back.
Hi, Danny.
Matt Morzy is investment team manager and a CFP at Annex Wealth Management. Welcome back to you.
Hey, Danny.
And to demonstrate the power of the team in from the bullpen, because this is a big tax question that we're going to lead off with, is Tania Sinha, CPA, manager of tax planning at Annex Wealth Management. Welcome.
Thank you, Danny.
Our first one is from Liz. I made the decision to convert some of my traditional IRA, and I did not withhold tax from the converted IRA funds. My current tax withholding will not cover the amount due. I'm unclear as to when estimated taxes will need to be paid to the IRS, in a lump sum or scheduled payments, in the month of the conversion, at the end of the quarter, at the end of the year, at the time I complete my 2023 tax filing. I'd like to wait as long as possible, but without penalty for not paying 90% on time. Tania, it is a complex question, isn't it?
It is. Hey, Liz, if you are under the age of 59 and a half, then you did the right thing by not withholding taxes from your IRA. There is a 10% penalty for withdrawing funds from your IRA, even if that withdrawal was made to pay conversion tax. Usually, we recommend paying taxes from your brokerage account or bank account. Since you mentioned 2023 tax filing, I'm assuming the conversion was just recently done in 2023. And looks like you are a W-2 employee. So my suggestion would be to increase your withholdings at work. That would be the easiest way to go about it. Based on how much IRA you converted and based on what tax bracket you are in, you can calculate the numbers and make the changes in your withholdings accordingly. And you did mention safe harbor rule of 90%. So I want to just make sure we are on the same page. The IRS is not going to charge you an underpayment penalty as long as you paid 90% of your taxes owed for the current year or 100% of your taxes you owed for the previous year. And be mindful, if your gross income was above $150,000, then that threshold is 110% of your gross income. We do often get similar questions when a family has a W-2 and a side hustle. So in those cases also, we always recommend, as long as you have a W-2, the easiest way for withholding from your side hustle is also just increase your withholdings at your W-2.
Sarah, are you glad you didn't get that one?
Oh, boy. Yep.
Yeah, how about you, Matt?
Yeah, I like the investment questions. I tend to be a little bit easier.
That's why we're built as a team. Second one is from Phil. What's the difference between a fund of fund and a target date fund? They're really close, aren't they?
They're very close. A target date fund would be a kind of a fund of fund model. Typically in a mutual fund or an ETF, you have investment manager picking individual stocks or individual bonds. But in fund of funds, they're using other funds within that to create the structure that they're looking for. So a target date fund would be usually used in like retirement accounts. So think 401ks or 403bs. So for me, if I'm going to retire in 2080, then I'm going to have a risk tolerance to match that. There could also be more conservative ones. So if you're going to retire in 2025, you're probably going to be much more conservative, and they blend that allocation over time. Other types of fund of funds could just be based on risk tolerance. So there could be an aggressive allocation or a conservative allocation that aren't necessarily tied to a specific savings goal, but just a risk tolerance as well too, but very, very similar.
Next up is Anonymous. Is replacing 70% of my pre-retirement income the mark to shoot for?
Well, the 70% rule is a good starting point, but from what I've been reading, the actual percentage can vary considerably between 54 and as high as 87%. It all depends on individual circumstances.
Next one is from Don. Are Roth conversions done over a number of years or all at once?
Well, we typically suggest spreading them out over the low income years. So those years between retirement and required minimum distribution age. Reason being is we want to be very tax efficient. Not to say you can't, but it's just not the norm. So when we help our clients with tax planning and suggest doing a Roth conversion, we have to take a look at several things. Since Roth conversions increase income, what will that extra income do to their tax bracket? Their Medicare premiums, we have to be very conscious of that IRMA threshold. Will it increase the amount of the Social Security that is taxed? And of course, we always plug it into the client's financial plan to see the long-term impact of doing that Roth conversion. So will it really benefit their plan or will it benefit their beneficiaries?
When somebody is doing Roth conversion, apart from Social Security and IRMA threshold, we also need to be mindful of all the deductions and credits they are getting at present because Roth conversion increases your taxable income.
And our final question is anonymous. How important are stock downgrades, like hold, underperform, sell?
Yeah, they can be really important in the short term. So if a company has bad earnings and so analysts come out and move it to underperform or to sell, you could see that the market would really move that stock price that day, and you could see a pretty big sell-off. Important things to note on that is what has that track record of the person who is putting out the analyst opinion? Are they usually accurate? There's a lot of different rating systems out there for these people, but also what's happened already before they got to that spot. Do you think we're coming off a year where the market has sold off pretty hard? We're just now starting to see a lot of downgrades, but stocks could be down 50 or 60% already before analysts are coming through and saying sell. Maybe they're a little late to that party. Other thing we want to look at too is how many people have buy, hold, or sell on each stock, and then what do we think about it as well too. So if there's a stock that we like that does not have a lot of buy metrics to it, where people are putting that out there, but we like the stock and it's starting to go up, they might be late to the party and start to push that stock upwards as they start to see that information flow through as well too, and you might be ahead of the party.
That's Ask Annex. Sarah Kyle, thanks for joining us.
You bet.
Tania Sinha, thank you.
Thank you, Danny.
And Matt Morzy, thank you.
Thank you.